There are so many fake investment gurus on YouTube that are selling you guys these stock analyzer tools and blah, 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 which in my opinion are probably bull. And so in this video, guys, I'm going to give you a free stock analyzer tool that you can just take for yourselves, print it out, do whatever you want with it, and use it to help yourselves become a better investor. And so as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. And you know, a lot of you guys have been paying for these stock analyzer tools. I'm seeing these large YouTube channels sell this stuff, and the truth of the matter is, like, I'm not judging you guys if you want to pay for it. By all means, do whatever you want with your money. But the point that I want to make is that there is no such thing as a shortcut when it comes to investing. And I'm just going to be flat out with you guys. And the truth is, for any of you guys who have subscribed to the Patreon and you see the way that I build out those models, compare any two companies on the tracker. There's, you know, over 100 companies there that are fully modeled out. So take any two and you realize that they're all different. They have similarities, you know, like they all have revenue and etc. But like when you look at their individual segments and how growth is forecasted out and everything, like how just even like I focus on specific key performance indicators as it relates to the specific industry that it is, it's all different. And so there aren't tools that can really help me break down the company's fundamentals. And so this is why this is what my stock analyzer tool looks like. So this guy has actually been in the description of every one of my videos for a while now. And I say it right here. There are no tools or shortcuts with investing. You have to do the work. And so if you want to learn more, I mean, you can join us every month, but I'm just going to give this all away to you for free right now. I've talked about this before on the channel, so I'm going to walk through these 4 questions in this video right now. And so get ready, guys. We are going back to school when it comes to learning about how to pick investments and sort of like invest using the 4 questions that Warren Buffett uses. And so the first question that I do believe that you guys got to be asking, and this is the most important question in my opinion, is this a company that I understand? Now, I recently put out a video on chip makers. Chip makers are very hot. They're very popular. But, you know, the first thing that I say in that video is, listen, this is out of my circle of competence, and I'm not afraid of looking dumb or incompetent when it comes to the fact that I cannot invest in NVIDIA, in AMD, in Intel, because I just don't understand the industry. And it's okay. Look, Warren Buffett is invested in Taiwan Semiconductor. I'm okay with saying, hey, look, that guy's smarter than I am as it relates to investing in these chip businesses. I just don't have that competency. But I can invest in companies like Canada Goose that's now run up, you know, 15% in the last month. I definitely understand the business of creating jackets and selling them, especially, you know, considering that's a home field advantage for me because I see how crazy people go for that brand in Canada. So I absolutely can see people going crazy for that brand globally. And so, you know, the first thing that I would ask when it comes to, you know, understanding or determining if you even understand the companies, can you do a SWOT analysis? This is just business school 101. Can you understand what the strengths, weaknesses, opportunities, and threats are relative to its competitors? And so the key to this, these last 3 words, is that you have to understand the industry. You have to understand what sets this company apart from its competitors. And there's something very interesting. If you ever read any book written by Peter Lynch, the one thing he always says is when he would look at the competitors for the company that he's initially interested in, he would inevitably end up buying the competitors. But he understood the industry. He understood what each company represented in the industry. He understood what made them strong, what made them weak, and that caused him to inevitably go to a competitor. I've also done that very often in my investment career. The second item that you can do is look at the financial statements and understand exactly how the company makes income and ask yourself if it makes sense over the long term. You know, there's a lot of people who lost a lot of money investing in companies that had sort of like no income in the current year, but you sort of expect them to make income down the road. But a lot of those investors didn't ask, is this sort of income generation sustainable? One example was Open Door. And, you know, I don't really talk negatively about a lot of companies on this channel, but, you know, I positively told you guys maybe, you know, over a year ago that when that company was trading at $30 per share, it was worth around $3 to $6 per share. And the reason why I was able to come up with that is because they were saying that they're going to revolutionize the home buying market. And they said they had this huge total addressable market of pretty much every home that was sold. And I said, That's not reliable. And in fact, I suspected that the real total addressable market for the iBuying segment was less than around 5%, maybe 5% of the overall market, if that. And so I saw a much slower runway for Open Door than, most other investors at the time did. And so that allowed me, just on question one, to dismiss the opportunity as a whole, because I just thought, management was seeing blue skies, which don't fault management for that. They should absolutely believe in their product that much. I would want to hire people like that, believe it to the point that it doesn't even make sense. But as investors, we sort of have to make business-like decisions and say, does this really make sense? And, in that situation, it didn't make sense at all. And so it was a company that I decided to pass on, even though I love the idea of iBuying. And of course, you guys know that stock barreled downwards and a lot of people lost money on that name. And so that goes to this point here, like the Open Door situation. If the company is unprofitable, I'm not saying that it's not potentially a good investment. What I'm saying is tread carefully, understand why it's not profitable, and ask yourself if there is a real easy to see reason that they will become profitable in the future. The second question that I would ask is, does the company have favorable long-term economics? So this kind of goes hand in hand with the first one. So the first one is, do you understand the company really? And the second one is, do you think that this company will be sustainable over the long term? A couple of names that are easy to determine if they're going to be sustainable over the long term would probably be like a Starbucks, Microsoft, McDonald's, Nike, Disney, the, YouTube, Google, etc. Like the list goes on and on. But there's a lot of companies that people invest in that they may not necessarily be around for the long term. One name that a lot of people got in trouble with as they followed a particular YouTuber down the path of was a company by the name of Tattooed Chef. And I think that company is probably going bankrupt now. I don't know. You guys let me know. I haven't really been following this story, but it sounds like that company has declined by over 90%. So that's kind of crazy. Another story that a lot of people lost a lot of money on was Tesla, right? Look, I love the idea of EVs, and I love, Elon Musk, his business acumen and just the ability for him to change the world. And this guy wants to go to space. Like, you want people like that and you want to support them. But at the same time, can I really fall behind? Even a year ago, can I get behind that 50% a year into sort of like the medium-term growth rate for the top line? I couldn't believe that. And so we're now seeing issues with that, but we're not only seeing issues with that, we're also seeing issues with the margin profitability for these EVs as more competition comes out. And these are issues that I saw not that long ago, just like a month ago, and then it started getting announced, of course. But the point that I'm making is that, when I think about like long term, like maybe, I didn't expect that the margin issues would come up so soon with Tesla, but like I definitely saw, revenue declining and margins coming closer to what like the regular margins are in the auto business as we think into perpetuity for this company. Now, some people don't look at Tesla as an auto company, and they look at it as like a robo-taxi business and whatever else it's going to become. But I would say that that's a lot of pie in the sky, and there's a lot of hurdles that could happen before that vision that you have for the world with that company happen. And so the question is, can you reasonably and accurately forecast that? And my answer is no. And that's partly the reason why the share price is declining right now. And so, the first question really aligns with that whole Tesla issue, is that will the company be competitive over the very long term? Not just are they competitive right now, can you see them being competitive over the very long term? A good example is the cola market, right? Coca-Cola and Pepsi are going to own that market for as long as I'm living. I absolutely guarantee that. You can have a billionaire like Richard Branson come in and try with his Virgin Cola, but it's not going to go anywhere. And so again, here's where the SWOT analysis comes in very handy, especially in the opportunities and threats section. You'll nail this with just a SWOT analysis. Now, is it an industry that's constantly changing? Technology is. Now, Elon Musk's perspective on this is just always be ahead of change. And I understand that it's a very optimistic outlook, but you could be the hardest worker in the room, but you still get beat out by somebody who's just got better technology. And so, I'm not looking for an industry or a business that's hard to run. I'm looking for a business that's easy to run, but also easy to defend. And so, why are you convinced that this industry will not undergo any change over the next 100 years? And so, I try to ask this question for a lot of the businesses that I like to invest in. For example, Canada Goose was one of those where, I don't think cold weather is going to go away, and I don't think people's desire for luxury clothing is going to go away over the next 100 years. But will there be other luxury clothing brands that come about? Yes, I think that'll probably happen. But can Canada Goose remain competitive over that time? I think they likely can. Will they? I don't know, but I think they have a strong chance to remain somewhat competitive. They don't have to be number one. They don't have to be number two. But the whole point is that, there's not going to be an insane innovation in luxury warming jackets that's going to cause Canada Goose to go out of business. That's kind of the way I'm thinking about that. And then, if you can't determine if the industry or products are sustainable over the long term, you cannot value the company. Now, I value companies all the time where I tell you guys I don't know what it's going to be valued in the future, but I'm very conservative on them. Just look at my valuation models for the chip makers, and you'll see how I'll give those guys rock bottom valuations just to give them valuations so that I can talk to them on the channel. If I didn't have this channel, I wouldn't have even built models on those chip makers. But this is because, this whole point is because equity valuations rely on a perpetuity multiple. And, you can make an adjustment for a finite life project using what's called an IRR, but that's not what we're doing here. And so, the whole point is if you can't determine that the company will be sustainable over the long term, you can't value it. Question number 3 would be, does the company have competent and willing management? A lot of companies have competent management, a lot of companies have willing management, but how many companies have both? I would say, in the top 500 companies in the world, they probably all do, but you just have to gauge their competency and their willingness to drive the ball forward. And this is where it falls on your hands. And so, for competency, I would say review operating metrics. A couple that are universal are the return on equity and return on invested capital metrics. Are they competitive in their industry? But also there's always industry metrics. So insurance industry has its own metrics, retail has its own metrics. So compare their industry's metrics to the competitors in the industry. And so once you do the SWOT analysis, this would be in the threats section, what sort of threats are they getting from competitors, or competitors doing things better than them? You'll see that flush out in the metrics. Now, are they delivering on their stated goals? Not every company publishes medium to long-term goals, and that's okay. But even those companies that don't publish medium to long-term goals, you can just look at their historical performance to see if they're performing as what they would like to perform at, and if not, why not? And if companies publish lofty expectations, don't necessarily penalize them for missing their expectations. For example, Tesla wants to grow at 50% a year. I don't actually penalize Tesla for not growing at 50% a year or greater. What I penalize them for is the fact that other investors believe that they will get to that growth rate, and thus they value the company at that rate. I like the company. I think they're a trailblazing company, but I'm not going to buy it for anything over. It was trading at $1,000, or some people are valuing it at $1,000, and so I would never touch it for that price. The other area that I would like to understand is, are they reinvesting capital into a dissimilar business? Anytime management goes into businesses that they don't understand or they don't have experience in, be careful. So a good example is Zillow with iBuying. This is somewhat of a similar business, but it's really not, because Zillow is a platform to connect buyers and sellers. Zillow was not a platform for using artificial intelligence to determine the buying and selling prices for homes. Same with Meta with the metaverse, right? I ultimately think that Meta fails with virtual reality, but I think they will succeed in augmented reality. But we'll see how this plays out. And now, are they acting on behalf of the shareholders? Just look at the cash flow statement and see what management is doing with the cash flows. For example, one thing that I always look at and I talk about on this channel a lot is stock-based compensation high relative to generated free cash flow? So really think about that. as you sort of like think about how to invest in the business as a whole. Now, the last question, this is where a lot of people start, but I would say focus on this at the very end, is the company selling at an attractive valuation? So the first question that I would ask is the intrinsic value substantially higher than the current share price? You see me talk about this all the time on the channel. So is like a high margin of safety is our best safety against errors in our analysis, and effectively it's just guarding us against our own ignorance. And so, margin of safety is very important. I like to buy companies at less than 50% of their intrinsic value, but I have purchased companies, lower than 75. So, I don't just wait for it to come under 50%. But the other thing that I have to acknowledge is that my valuation isn't a absolute valuation. It's just my opinion, right? And so I acknowledge that my price target could essentially be too high or too low at the same time, right? And so, the other thing that I would say is that when you're valuing the company, do not fool yourself with your valuation inputs. Consider your inputs into your model. Would a reasonable and independent person consider them conservative? This helps you avoid falling knives. And to be honest, that's where you're going to make most of your mistakes. You're going to make most of them just being a little bit too optimistic. Some of the ways that you're going to be a little bit too optimistic is you're going to take historical performance and project that into the future. That's what a lot of people did with Alibaba. Another company where people made that mistake was on Alphabet. They took historical growth rates and projected that into the future, and we saw a slowdown in ad spending. Ad businesses are naturally cyclical, and so you have to be conservative in your valuations for those companies. But here's the thing. If you ask those 4 questions, and with the 4th question, if you build out a full-on model, and when you build out that model, you forecast it out on sort of like a segment by segment level, which you can see how I do at the Patreon at that lower tier, you will do much better than 95% of the investors out there. And you know what? You're probably already doing better than 95% of the investors out there because you're watching a channel like this, which is inherently more boring than the more exciting but pumping types of channels who are all now apologizing to you guys for losing so much money because they were bullish on the wrong companies because they did not consider these 4 questions. And so I'll leave it there for you guys, and I want you to let me know what you think about these 4 questions.